to build it the way a banker is going to see it, not the way a realtor is going to send it. A realtor typically puts in too much fluff, too many slogans.
Right.
You don't want to do that with a bank, with an asset manager. You don't want to put in when results count because it's a very negative connotation to it. So always remember, if you're going to get into the REO business, to make your resume and your broker approval package bankable. Speak their language. Bankers have a language, and the more you understand the language, the better off you are. So I could tell you whether you just got your license Monday or whether you got your license 20 years ago, you could be up and running in the REO business in the next 60 to 90 days if you want. But it's going to take some getting your market intelligence, putting together brilliant information, and marketing them. And I show you how to find the asset managers, how to find their phone numbers, their direct lines, and their email addresses, what to say and everything. It's very, very simple to do.
Wow, that's really some great information about, REOs, and we might just have to have you back on for another call just on that alone. But let's jump back into our short sale topic of today. Can you let us know exactly, what is HAMP and HAFA?
Sure. The HAMP program is the Home Affordable Modification Program. This program came out back last April 5th in the HAMP and HAFA program. We'll start with HAMP first.
All right.
The Home Affordable Modification Program. The president, when the economy started to take a hit, a big hit, realized that there was going to be a big issue and came up with an idea to where we're going to help people that are in distress. I think everybody can agree that if, we don't just want to kick people out of homes if we can.
Right.
So it's not just you missed a mortgage payment, that's too bad for you, 3 months, 21 days, you're out. Because it was happening to too many people across the country. So they came up with the idea of the loan modification program. And what this was going to do is they were going to help people that maybe they lost their income, or maybe they were making $5,000 a month and now they're only making $2,800 a month. And they were going to try to modify their monthly payment down to a payment that they can afford. The idea was a great idea, and I think we could all agree that we'd love to be able to help people.
Yes, absolutely.
The problem is it has been horribly mismanaged, and the result speaks for itself. Since that program has been in existence, the Wall Street Journal posted back in November that there have been over 4 million people apply for loan modifications. And they've applied for them. Now, of the 4 million people, only 325,000 have been approved on either what's called a trial modification or a permanent modification.
Wow.
Of that, 71% of the people ended up back in foreclosure within 6 months.
That's amazing numbers for, all of those applications, and then, two, the results just aren't there.
Absolutely. Well, as you know, they took too long to do.
Yeah.
There are some people that are waiting on a loan modification, and they will wait for a year before the bank comes back and says, I'm sorry, you don't qualify. Now, that just doesn't make any sense at all, because we know definitely using your team there at Wells Fargo, this is how great you guys are. Anybody on this call can call in and speak to anybody on the Powers Now team, and they will even go out and meet your buyer out at a Starbucks. And if you bring in if your buyer brings to the loan officer their tax returns, their pay stubs, their W-2s, the loan officer at the Starbucks can run the credit report through Wi-Fi, input it to their system, go to Fannie and Freddie Direct, and have a pre-qualification or pre-approval issued within 10 to 15 minutes.
Right, right.
And of course, subject to conditions.
Mm-hmm.
So working with your team, that's the kind of service that people are accustomed to. Now, you tell me, what's the difference between that and a loan modification that takes a year to review? Too much paperwork and too much saturation.
Right.
So the loan mods are just not going through. So what the lenders come up additionally with the HAMP program is if you don't qualify for a loan modification, then the bank is going to put you into the process of what's called a pre-approved short sale under the HAFA program, the Home Affordable Foreclosure Alternative Program. And what was supposed to happen under this system is that people that were already declined on a loan mod would automatically be put into a HAFA program, a pre-approved short sale, because the lender already had all of the information. Well, that bridge never took place because many times if a loan mod is turned down, then they have to start a HAFA program, and they need all the new information again. So there's something going on internally with the banks where this isn't registering to be done quick.
Right.
Unfortunately, what this is doing is destroying the credit of the people that are out there in a distressed situation.
Right.
Because of the fact of if somebody's going through a short sale for, 12, 13, 14, 15, 18 months, their credit is destroyed.
Right, and a lot of buyers actually think that it's better to do the short sale than the foreclosure because of, their credit. They want better credit, with doing a short sale.
Yes, this is absolutely true. That's an outstanding point. A lot of people think that, but we know differently. And let's just look at this. Because a lot of people think that a foreclosure is worse on somebody's credit. Let's just take a look.
Right.
If somebody today, let's say they unfortunately lost their job because bad things happen to good people, and they lose their job, but they've got a little money saved up, and so they make their payment for 3 months and they run out of money. They're on unemployment. Unemployment only covers their basic necessities, so they can't make their mortgage payment. So then they miss a mortgage payment for 3 months, and the lender files a notice of default, a 90-day notice of default. The homeowner can't do anything. They have not found a job in between that 90 days. So now after 90 days, the lender files a 21-day notice of trustee sale. And after 21 days, the property goes to auction. In that scenario, from start to finish, it has been just under 8 months. So the homeowner would have 7 months of mortgage lates on their credit report and the word foreclosure. Now contrast that to some of these short sales that are taking a year to 15, 16, 17 months. Just look at this. If this takes 17 months, that means they have 17 mortgage lates on their credit report and the word short sale. So we all know this. 7 mortgage lates is a lot better than 17. 7 mortgage lates is a lot better than 12.
Definitely.
Irrespective of the word. So one thing that we as real estate agents and real estate brokers have to do, when I got my license my broker's license on June 10th, 1994, one thing that I read, and oh my gosh, it's amazing, is I read that as real estate agents and brokers, we have to have a fiduciary responsibility of the utmost care and integrity with our clients. It is my job to get a short sale done as fast as I possibly can. And if the bank is not going to participate, because banks do not want to do short sales, if they're not going to participate, I'm going to get out of it quick because I don't want my name associated with this person's bad credit. And I'm going to have them go to an attorney and do whatever they need to do from there. But it's my job to know what short sale can go through and what short sale can't.
Now, speaking of that, how do agents know whether it's a normal short sale that's not associated with HAMP or HAFA or a HAMP and HAFA, HAFA short sale? How do agents know what short sales will be approved and which ones will be declined?
Well, this is the good news. That's a great question. This is the good news. Whether it is through the HAFA program or just a normal short sale, the matrices are the same as far as the approval.
Okay.
So that's one thing. But let's look at there's 2 criteria that if you want to get your short sale approved, you have to use these criteria. Let's look at the market of what's really taking place and look at the market intelligence, because I always go by what I can prove. You listen to on the radio or on the news, depending on which news station you listen to, a story is always different.
Right.
So what I've learned is go by what I can prove, because I've been hearing that short sales are going to be the wave of the future. Now, I will tell you, it's an important part of your business, but it should never be your only part of your business. And and knowing what one can, what short sales can close is the big thing. Let's just look at this. The first criteria that you need to use in order for this to go is make sure you have a very legitimate short sale situation. I'll give you an example. I'll give you 3 different examples here. The first one here. Let's say that a person bought a property in Costa Mesa back in 2004 for $525,000.
Okay.
And now the property is worth $225,000.
All right.
And that homeowner thinks, you know what, this doesn't make any sense at all to have good money chasing bad. I'm not going to pay $500,000 for something that's worth $200,000. They have the same job that they had, back in 2004.
Right.
Their credit is still good, and they've got a little bit of money saved up in a 401k, and they're doing okay. They just don't want to make the payment. Is that a short sale? And that answer is no.
Absolutely not. That's not bankable language to say this is a short sale.
Right. That is a gross abuse of the system. But I will tell you this, there are a lot of short sales on the MLS that fit that criteria.
Right.
That's not one.
Wow.
Do another example. Somebody in Santa Ana bought the property for $500. It's now worth $250. They did lose their job. They did lose their ability to produce. They're out looking for a job. They're 2 months behind on their mortgage. They have about $12,000 saved up, and they're doing that because they don't know how long they're going to be out of work. And they also own another house up in Big Bear, and the property is worth $350,000, but they don't owe anything on it. Is that a short sale? Because we've got a scenario here. The property's over encumbered, and they're out of work. That does not just define a short sale. The second scenario there is not a short sale. Why? Because they have a home up in Big Bear worth $350,000 that they owe nothing on. They can take a lien out of that property to pay off this other one, or they could take a small lien against it, maybe $20,000 to give them the income to make the payment. So let's understand this. The fact that a person does not want to pay the mortgage is not a short sale. If they've got the ability to pay it, that is not a short sale. And they will have grave consequences. And please, if you would, just so I remember that, please have me explain what the grave consequences will be when I get done with this third one. The third one here is, let's take a look at this one. Somebody that lost their job 7 months ago, did everything possible to make their mortgage payment for as long as they could, borrowed money from their family, from their church, had a garage sale. They just ran out of money. They stopped paying their credit cards and car notes because they were trying to pay the mortgage. Their credit is shot. They don't have any money left, and they're just trying to do what they can to move on. That is a short sale.
That's a short sale, okay.
And that's the one, those are the ones that we're going to go after. Every now and then, another one is going to slip through the cracks, and that's fine, but don't base your business on that.
I see.
So the first criteria is going to be, is it a real short sale?
Is it a real short sale? And that would also be, you've come to that conclusion by, you've mentioned this term multiple times on the call already, your market intelligence. Can you just clarify what that truly means for our listeners?
Sure. What is the market intelligence? For instance, I spoke about, do the lenders want to do short sales? And I use market intelligence. So, for instance, we hear all this stuff of people saying that the banks want to do them. Now let's look at the reality.
Right.
The percentage of short sales in Orange County that actually close is at 17%.
17%.
17%. That means
Wow.
that 83% of the short sales are not closing. Now, I feel bad for the sellers in those situations because of the fact of we don't like to see that many people lose their home. But at the same time, they've already been struggling in it. The issue is so many real estate agents. Can you imagine 83% of those transactions not closing, how devastating that is to a real estate agent or broker when they work on a file sometimes for a year only to get declined?